Welcome to this trading course. This is an open access course, and here I'm going to go through the basics of technical analysis for crypto future trading. I'll give you an overview of a lot of areas so you can start the right way or correct the mistakes that you already might be making. So who is this course for? This is for people like you. Maybe you tried trading before with your own money. You have a capital of $2,000 to $10,000 or more, but it hasn't really worked. You're inconsistent, sometimes you make money, sometimes you lose money, and it's frustrating to you. Maybe you have a 9 to 5 and try to trade on the side to make some extra money, but it just doesn't seem to click. If that sounds like you, then this course will give you a strong foundation to start trading properly and avoid beginner mistakes. Before we start, for those who don't know me, my name is Mazine. I'm 26 years old from Morocco, and just like you, I had a 9 to 5. I started trading in 2021. Back then I traded altcoins, NFT and meme coins last year. I learned a lot the hard way. I made money, I lost money. Thankfully I made more than I lost, and now in 2026 I focus fully on futures trading. Why? Because futures are more predictable, more sustainable, and they allow me to make trading a real part of my life. I'm a digital nomad now, living in Vietnam of my trading skills, and I've made a system that works for me, not gambling, not chasing moonshots, and I want to share some parts of the system with you in this course so you can see how I approach the market, how I think about trades, and how you can start building consistency too. Also, a quick note, this is open access, but I do have a private community where I share my trades, and I also do offer mentoring and coaching for people who want to go deeper and really learn how to trade profitably. A lot of people ask me, why do you charge for this if you make money from trading? And the answer is that it took me years to arrive to this level, and I see this as a business. If I can help people and also get compensated for my time, that's very good, and it's an extra income for me. I still provide value for free on my Instagram account, my YouTube channel, but when I dedicate more time and value, I don't see a reason to do it for free. Alright, that said, let's move on to the course. Here is what we're gonna cover. The first chapter is the market analysis, reading the market, key price levels, support and resistance, market trends and momentum. Then the chart patterns, the recurring setups that hints at future moves. Then the second chapter is about smart tools, technical indicators, tools that helps confirm signals. And after that, the third chapter is about protect and plan and its risk management, how to control your trades and keep your losses small. This will be a conclusion, lessons you can act on immediately. Before we start, I also recommend creating an account on MXC. Right now, it's my go-to platform because of the low fees and some zero fees pair. I have a full tutorial on how to use the platform, and if you use my affiliate link, you can get a bonus at no extra cost for you. It also helps support the channel so I can keep providing more value. And I also recommend signing up on TradingView, and you can also use my affiliate link to get a free bonus at no extra cost for you. And once again, it also helps support the channel. One last thing before we dive in, this course is for educational purposes only. This is not financial advice. Success in trading requires more than technical analysis, proper risk management, and the other areas we won't fully cover here. This course will give you strong foundations, but I can't guarantee any profit. Now that that's out of the way, let's get started. So before talking about the technicalities, I want us to start from the very basics so it gets easier with you as we go forward. So this is what we call a chart. In instance, this is the weekly chart of Bitcoin, which means that each candle represents 1 week in this chart. And with it, we can see how much was Bitcoin worth at each moment in 2023, in 2026, in 2025, etc. So after we know that, us as traders, our job is to predict the next price of Bitcoin or any other cryptocurrency in the future. So we can do that by either longing or shorting the market. I'm gonna explain that later. But we do that using indicators, using strategies, using fundamental analysis. And in this course, we're gonna focus on the technical analysis, which means the chart analysis. Now here is the thing. Us as traders, we do not operate the same way as investors. Investors can only buy and wait for the price to go up, so they can sell for profits. But traders can short the price, which means I'm gonna sell at the top, and buy back at the bottom to make profits. And you will probably ask yourself, how is this possible? And it is possible because exchanges allows traders to do that, and that's what we call futures. And this ability of using futures to make profit is not the only abilities that exchanges allow you to do. They also allow you to use leverage. And leverage means you are basically borrowing money from the exchange to execute your trade. For example, you can borrow 10 times your money. So if you have $100, now the exchange give you $1,000, and the exchange tell you that you can make as much profit with this $1,000. But the catch that you have is that you can only lose 10% of this money, which is your initial $100. So if the price moves 10% to the opposite direction of your trade, let's say, for example, you long the market and you want the market to go up, and the markets go down, for example, 10%, then you are liquidated and you are no longer in that position. And by consequence, you lose your $100 because 10% of $1,000 is $100. But if the price goes up to your direction, you make $100. Now let's move to the candles. The candles, as we said, represent the price, and the candle has a body and a wick. A body represents where it started and where it ended. For example, in a day, we started in the bottom of the wick and we closed at the top of the wick. So in those 24 hours, we could have traded higher than that, and we could have traded lower than that. And this is what we call a wick. But the minute the candle closes, that's where the close is set. So it's very important to know that, and also to know that green candles means that we ended that time frame higher than we started it. And if it's a red candle, it means we went lower than we started. So how do we know if the price will go down or go high? There is a method called the support and resistance, and it helps us predict if the price is going to a direction, because in trading it's all a game of probabilities, and you should use both technical indicators and fundamental analysis to know if the price go high or go down. Now for this open course, we will cover some of the technicalities and it will give you a foundation for that. But as I said before, it's not everything. So with the support and resistance, you can identify potential entries, exit, because the price will most likely go between these two areas. The buyers do not want to buy at higher than this area, and the seller do not want to keep selling below this area. Now to identify this area, a lot of people get confused, so pay close attention to this. Most of the time when price arrives at a certain area and fails to close above it, what usually happens next is that the price go down. Price doesn't move in a straight line. It moves in a zigzag way. Up, down, down, up, down. So how do we identify resistance? It's very simple. The price moves into an area, it gets rejected, and the candles are not closing above that level. As long as we don't see a candle close above it, that area is still resistance. And the same logic go for the support, it's just the opposite. When the price come down to an area, buyers step in, and the candle keep closing above that level. Here there can be some confusion because a lot of people think that a touch means a break, but it's not true. What actually matters is how the price closes, not where it just trades for a moment, but actually where it ends. Another thing that I personally like to look at is the clean price levels. Levels like round number like 60k, 70k, we have the 100k, which is very important in Bitcoin because a lot of traders place their buy or sell orders around those prices, and because often these prices react more than the other ones. So when a support and resistance line up with a clean round number, that level become more important. Sometimes you'll also see the price move slightly above the resistance or slightly below the support. These are usually called the outliers. That's why it's very important to zoom out and look at the higher time frames. The higher time frames carry more weight. For example, the weekly levels are more important than the daily level, and the daily levels are more important than the lower time frame, such as the 4-hour. On the lower time frames like the 4-hour chart, we look for the same thing: multiple rejection at the top and multiple bounces at the bottom. But we always want confluence and homogeneous with higher time frames before trusting a level. Over time, the price will eventually break a level because obviously we need to move to another one. Now, when the resistance breaks, we wait for a price to come back and retest it. And the retest is very important. If the price holds there, we can say resistance has flipped into support. And same thing goes the other way. But this is very important. Never assume a flip without a confirmed retest. Until the retest happens, price can easily fall straight back through the level. Now let's talk about the trend lines. Support and resistance are not only horizontal, they can also be diagonal. A trend line becomes valid after at least 2 touches. The more touches a trend line has, the stronger it becomes. But after multiple touches, the probability of a breakout also increases. So on each touch, we are closer to break that pattern, and it's very important to plan your trades ahead. One important rule is that a trend line should not cut through candle bodies on the time frame you're drawing it on. Wicks are fine, but slicing it through the bodies make the trend line invalid. When a trend line breaks and gets retested, it can flip from resistance into support or from support into resistance. So support and resistance are not just boxes, they can also be trend lines. Finally, how do we use this strategy? When price is moving sideways, you can look to short near resistance and long near support. And you repeat this until the structure breaks. Even with just the support and resistance, there are already opportunities to trade, whether price goes down or go up. So that's the foundation of supports and resistance. Once you understand this, everything else becomes much easier. Okay, now that we talked about support and resistance, let's learn about trading trends in crypto. The biggest mistake new traders make is being too late to the trend. They get scared when prices drop and get greedy when the prices go up. And this makes them do the wrong thing at the wrong time. And timing in crypto is everything. So here is what happens. In this graph, we can see that the Bitcoin started going down, and most of the new traders will think that that's it, it's the right time to short. And the main problem here is that they're already late. So the price corrects and they get liquidated or get stopped on their position. And same thing happen again. The price starts to go back up again and they think we're going full up, and they long the market and they get stopped again because they're already late. They should have done it before, not when it's happening. And this usually happens not only in future, but generally that's how the markets take the money from the unexperienced to the experienced ones. Most beginners keep shorting the bottom, longing the top, and we don't want to do that. I'll show you how you spot trends early so you can get better entries. There are different ways to trade trends. Some people take one big position, they wait for confirmation, enter once, and hold that trade for the whole move. Me personally, I don't trade like that. I like short trades. So during one big move up, I'll take several long trades. I'll close them during small pullbacks, and I will get back when the things looks good again and when I have my setup ready. This way I can keep making money from the trend instead of just one entry and waiting for it for days and weeks to end. The first method that I talked about is swing trading. So these are the trades that happen on the bigger time frames like daily or weekly charts. And once a reversal is confirmed, the traders enter and hold that position for a big move. But they also take profits along the way and they get out when the reversal signs show up. So the same idea can happen for the shorts during strong downtrends. You hold the price until it hits a major support area. And that's usually how swing trades usually work. And you might wonder how traders decide to go long or go short, and this is where the technical analysis come in. Trading is all about probabilities, and you need to make a decision that has a high probability to happen. So we look at many things: trends, indicators, patterns, structures, and build an ID based on what's most likely going to happen. Based on that, we decide if we want to go long or go short. I'll go much deeper into this later, so don't worry about it now. And next, I'll talk about confirming trends and spotting a reversal. To confirm an uptrend, you need at least one higher low and one higher high. Price makes a low, goes up to a high, pulls back, but stays above the last low. And that's your higher low. When the price then breaks above the last high, you've confirmed an uptrend. Once that happens, expect the price to keep making higher lows and higher highs until something breaks. For a downtrend, it's the opposite. You need a lower low and a lower high. So it goes this way. The price drops, bounces, then can't reach the last high and drops again. Once the lower high is confirmed, you have confirmed a downtrend. One important thing you need to know is that the time frames matter. A trend on a small time frame might just be a pullback on bigger time frames. So you always need to look for agreement and confluence on other time frames. For example, a downtrend on the 4-hour chart might already be a part of a bigger downtrend on the daily chart. Another mistake that I see beginners make is that they try to trade against the trend. I see this all the time. There is a clear strong downtrend and people keeps trying to go long, hoping for a turnaround. And it's true, sometimes the price bounces a little, but without a confirmation, your trade is most usually going to fail. You always need a confirmation before trading a reversal. So how do you confirm a reversal? Here is how to do it. Here, for example, we had a downtrend line that kept the price down for a while. Once the price broke above it and then bounced off it as a support, that is the first warning sign that things are changing. And after that, the price started moving sideways. That showed selling pressure was getting weaker. And at this point, the price was at a decision area, whether break lower and continue down or break above the last high and then turn bullish. So as you can see, once price broke above the last high, it started making a higher high. And after the first confirming candle, you have to assume the trend has changed and that the higher lows and higher highs will likely follow. So this is actually where beginners mess up. They usually keep shorting even after the trend has flipped and they expect another drop that never comes. Once the higher high is confirmed, you can enter right away or you can wait for a next pullback and enter at the higher low. Both ways actually work, but the key here is that you're now trading with the trend. Now there are two different ways to trade these trends. You can either scalp on small time frames, which usually means higher leverage, but much smaller position size. But the higher the leverage, the smaller the time frame you should trade, since you only need a small price moves. But anything above 20x leverage is already very risky. Especially for beginners, you should always start small and never put your whole account into one trade. And then the second option is to swing trade. Because usually swing traders use lower leverage and bigger margin because they're trading bigger time frames, like for example the 4 hours, the daily or the weekly charts. So it depends on your strategy, but usually this is how it goes. So now I'm going to discuss the trading patterns and how to identify trading setups on the chart. First, I'll start by talking about a common mistake a lot of beginners are making and which I will help you avoid. So here in this chart, we can see a bearish flag pattern which can form during a downtrend, after which Bitcoin or whatever crypto you're analyzing starts to consolidate upward a little bit. So a lot of beginners tend to see this downtrend and they think that it's going to be followed by an upward trend, and they think that the downtrend has ended and it's better to long this. However, they're often wrong because this is actually a bearish trading pattern, which actually means that it's more likely going to break down and not up. So this misconception will lead them to enter a long position just to see another leg down and incur losses to their positions. So this is actually a very good example that you need to recognize the trading patterns in the chart. It will help you and give you a clearer idea of where the momentum is heading next. So to confirm a trading pattern, it's better to analyze the highest time frame where the pattern is still visible. So for this bearish flag pattern, we can see the 4-hour time frame, but if we zoom out to the daily time frame, the pattern nearly disappears. So the daily time frame is not suitable for this bearish flag, but the 4-hour time frame does still work perfectly. And it might also be applicable to the 1-hour time frame, but the 4-hour time frame is the best fit for this example. So the main idea with this trading pattern is that a breakout will eventually happen. But in this case, since the bearish flag has a bearish bias, we should watch for a break of the support downward. So there are several ways to confirm a breakout, but the main way is to observe the candle close. So in this example, the 4-hour candle closes right on the support line, but the next one closes below it, which indicates a breakout. Technically, you could already open a short position right at that point based on that. But as you know, trading, it's all about probabilities, and we need to gain more confidence on this breakout. So the second signal that I will look at is to examine the volume indicator, which can be easily added to your charts. And when we look at the volume traded for each candle close, we can see that while we're still in the bearish flag pattern, the volume is relatively low. But after the first candle close, we can see that there is a significant spike in the volume, which provides another signal that the breakout is actually happening and is actually real. So at this point, we have 2 out of 3 signals that the breakout is happening, which can increase our confidence in this short trade. So if you haven't already entered, it's starting to look more favorable for taking that short position. And the final third signal to confirm this breakout is to look for a retest of the breakout point. And if you can see all these 3 confirmation, you would have a solid basis for believing that the price is indeed going lower. Now let's talk about the price targets for these breakout patterns. After confirming a breakout, you can calculate the price target by taking the length of the flagpole, but it's crucial to understand that this price target only becomes active once the breakout is confirmed. If you're still trading between the 2 wide lines during consolidation, you shouldn't open a short position yet, as the price could easily reverse and invalidate the pattern. For example, if we see a confirmed breakout, the price target becomes active. However, if the price drops significantly below the target, this doesn't mean you did something wrong. It's entirely possible for the price to surpass or fall short of the target. These price targets act as indicators of where the price might head, but you shouldn't view them as definitive levels that must be reached. Personally, I like to take profits a bit before reaching the full price targets. There might be some occasion where the price exceeds the target, and there are also a lot of times when it doesn't fully reach it. So if you fail to take profits beforehand, you could still incur losses even if your analysis was correct. So it's very important to take this into consideration. Now let's explore some example, starting with the bearish breakout scenario. You can now start to see that all what we've been discussing so far is aligning to help you potentially profit from the daily price action. So in this example, we can notice 2 lines, one representing an upward resistance and another one representing a support. So if you extend these lines, they will eventually meet, and this pattern is called the rising wedge. It will help you identify potential trend reversal on both the lower and the higher time frames. A rising wedge is a bearish bias pattern which indicate that it's more likely going to break downward. And if you consider the upward resistance line, it rises at a slower rate than the support line. So eventually the price will struggle to keep the pace with the rapidly rising support line, making a downtrend breakout more probable. And now let's discuss some specific lines I've drawn also. So this line, for example, at the widest point of the wedge, helps you establish the price target. And this line is replicated at the breakout point, serving as the exact price target for this breakout. So to trade this pattern, you would see the price moving within the wedge until it eventually breaks out. So after the candle closes below the support line, the price comes back up to the breakup point, but it fell to close above it. So it gives you increased confidence in this rising wedge breakout. And at this point, you could enter a short position, setting a stop loss above the highest point of the wedge and placing your take profit level at the price target or slightly higher instead in case of a potential early stop. So next, I'll show you a bullish breakout example. Here we have a symmetrical triangle pattern that is formed by these two lines, one descending line of resistance and one line of support. A breakout above or below this pattern can set the price targets in either direction depending on where the breakout occurs. So to calculate the price target, you need to see what is the distance from the initial high to the initial low and extend that distance to the breakout point, which is indicated by this line. And here there is an interesting scenario that happens in this pattern, as there is a fake out. The price breaks downward, suggesting a strong price target below, but this breakout is invalidated when the price returns inside the pattern. So this situation shows us that it's very important to wait for a confirmation, because a retest that fails can lead to losses. So if you had waited for a retest, you could have made a more informed decision. Now I want to address how to handle mistakes or fake outs in your trading. I'll talk about this deeper later, but I want to give this example here. For this example, we start in a downtrend, but if we zoom out, we see a longer downtrend and an ascending triangle which has a bullish bias. So when the price breaks upward, it will seem like everything is proceeding as planned, with the price target set and with your stop loss set. But as the price suddenly reverses, how do you actually respond to that? So here it's very important that if you had waited for a proper confirmation of the breakout, you wouldn't have faced this situation. So since the price failed to retest, it indicates that you shouldn't have entered this trade. But if you did go long after the initial pump, you can reduce your risk by moving your stop loss higher. Initially set just below the breakout point, you can adjust it to break even or even into profit if you see a very big move upward. So this way you can close at this trade, and at worst you will break even. And as the trade progresses, you need to always consider moving your stop loss into profit to secure your gains. This strategy is very important, and I will talk about it more later on. So I really encourage you to keep studying these patterns and develop your understanding of how you actually can trade them effectively. I cannot cover every single pattern in this video as there are many, but I will provide you with some of them and you can research more later on. So each pattern has specific characteristic and price target calculation, so you need to explore them independently. That way you can improve your trading skills. So now I'm going to go over some indicators that I use and that help me with trading. Basically, before we move to the indicators, I want to show you how you can add an indicator in TradingView. And this is something that is very simple. You just need to be on your chart, and if you click on the top button that says indicator, you can search for the indicators that you want. For example, if you type volume, you're gonna see it, and if you click it, it's gonna be applied to your chart. And you can remove it as well or hide it just by hovering over it on the top left. It helps confirm breakouts, and that's something we covered previously. But beyond that, and that is the most important part, it can also show you where the big moves and the reversals are happening. Each bar at the bottom lines up with the candle above, and that's how you can tell when volume spikes actually matter. So for example, if we look at this weekly chart, you will see a bar that shows a really big spike in the trading volume, and that's something you need to look at. So if you check the volume, you'll notice some big down move also lines up with those spikes, and that's exactly what you need to be looking at. This spike in volume pretty much marked the bottom of the downtrend, and another spike aligned with the big red candle, and that's when we get a little reversal back up. And there is this 2022 bear market low, and that spike in volume lined up with that too, and after that we saw the bull run starting. So that's why this volume indicator can be really useful, especially on higher time frames, and at the same time that's why you also shouldn't just rely on it by itself. You need to confirm with other indicators and chart patterns as well. So let's talk about them. Now moving on, let's talk about the simple moving average, or SMA, and this is how you add it. You click on the indicators again and type the SMA. Then after it's added, you can change it. I usually pick the 21 SMA, and that's calculated based on the candle closed, and that means that the line on my chart represents the average of the last 21 closes, and that's how you can actually analyze it. Because a shorter moving average, like for example the 7 days, will react faster to momentum changes, and a longer one like 50, 100, 200, it will give you more of a long-term support and resistance idea. So for example, if the price bounces off SMA, that's actually a bullish sign, and if it breaks below it, it's actually a bearish sign. So this 21 SMA here is showing market momentum, and that's why traders look for long above it and shorts below it. And then you can also add the EMA, which is the exponential moving average, which is a bit different because it gives you more weight to the recent price action. And a lot of traders use the SMA and EMA together in a crossover strategy, and that's how they spot the momentum shifts. So if EMA crosses above the SMA, that's a bullish sign, and if it crosses below it, it's actually a bearish sign. But don't just blindly follow that, because if the market is actually choppy, you will get a bunch of false signals and fake outs, and that's why you need to combine it with support, resistance, and multiple homogeneous between different signals. And now let's talk about the RSI. It's one of my favorites as well, and a lot of people use it. And the RSI basically go from 0 to 100, and when it's above 70, that actually means that we are overbought. When it's below 30, we're actually oversold. And that's how you can find potential longs or short position. But you always need to keep in mind that we can stay overbought or oversold for a long time. And one more thing that you could also do is actually to watch the RSI trends. So you can actually as well see the momentum on the RSI and see the patterns on the RSI, and typically overbought or oversold RSIs will move back toward the 50 range, which is the middle range, either slowly if price moves sideways or faster if there is a bearish momentum. And if we move to 50 RSI, it doesn't mean that we are in a neutral momentum. You have to look at the trend of the RSI itself, but also you need to combine it with the chart. If it's a downtrend at 50, the market's probably still bearish until the line is broken, and that's when you might see a reversal spike before it shows up on the price chart. Now let's talk about divergences. A divergence happens when price makes a new high or a new low, but the RSI doesn't, and that's how you can spot weakening momentum. Regular bearish divergence is when the price makes higher highs, but the RSIs makes lower highs, and that's actually your warning. Regular bullish divergence is the actual opposite. The price makes lower lows, but the RSI makes higher lows, which shows a potential strength. And this can happen on any time frame, but you always need to remember that bigger ones on weekly charts are more significant. And there are also hidden and exaggerated divergences. Hidden ones are like regular divergences but weaker, and exaggerated ones are subtle, showing the trend is losing strength but not fully reversing yet. And if you see a bearish divergence while you are long, you need to take it seriously because these divergences are actually powerful. And now let's talk about the Fibonacci retracement, which is also a great tool that you can use for entry and exit points. So all you need to do is grab the tool, draw from the swing high to the swing low in a downtrend, and you will see all the important levels. The price will often react in these levels, and if it breaks through, it can continue higher. And if you want, you can also draw the Fibonacci support from the low to high. There is also the Fibonacci extension that are similar, but they help you find targets after a pullback. So all you need to do is draw low to high, then back to low, and then you will see all the important level. So the higher levels in the Fibonacci are actually very risky because it means that the price is very extended, so it's smart to take profit instead of blindly chasing the higher targets. So now let's talk about the Bitcoin liquidation heat map. So this map is actually different from the chart that we've been seeing, and actually it shows the liquidity of Bitcoin. Where are people placing their longs and placing their highs? For example, if you see a high yellow area, it means that there is a lot of liquidity there. So what is most probable is that Bitcoin will go to that area to search for that liquidity before moving to the next step or the next target. So what you can do as well is see the heat map in different time frames. Okay, now let's talk about the risk management. And this is one of the most important parts in trading. And before we move forward, I just want to clarify what I actually mean when I talk about risk management. So I've seen a lot of people getting completely wiped out and losing their whole account balance. And when I see those people losing their whole account on just one position, that tells me that they either don't really get what risk management is, or they're just not using it at all. So the entire point of trading in the first place is to actually grow your money by doing proper analysis and having a real plan. Not just throwing money around like you are at the casino gambling and hoping to hit big. So what I'm hoping to do right now is to give you some practical takeaways that will actually help you handle risk in a smarter way. So let me start off by breaking down what leverage actually means. I know we talked about it in the start, but I want to go deeper here. So the thing about leverage that you actually need to understand is that it directly raises how much risk you're actually exposed to, which is why I need to bring this up when I talk about risk management. Let's say you have $100 and you decide to open a position with it and you use the 10x leverage. What you're really doing is controlling a position worth $1,000. So if the price goes up by 10%, you've actually doubled your money, because that 10% gain will get multiplied by your leverage. But the thing is that if the price drops by 10%, you will lose 100% of what you've put in. So now let's say you move to the 20x leverage, you are controlling a $2,000 position. At this level, if the price shifts in your direction by only 5%, you will double your money. But if it goes the other way by the same 5%, you will be completely done. So there is not much room for error here, especially if you're still figuring out how the market actually moves and behaves. And that's exactly why increasing the leverage always means you're taking way more risks. So there is something that actually happens a lot to people, which is they are in a trade and they have proper risk management and proper targets, but then what they do is that they make their targets so far. For example, as you can see here, we already had a previous all-time high. The person taking the trade will not take profit here, and we say that this trade will keep going up, so there is no real need to take profit. So the trade never goes there and it actually go to its stop loss. And basically this person never took any profit and just kept on dreaming about a moonshot goal that never happened. And this is exactly why stop losses exist in the first place. If you're ever in a trade that's running really well for you, you need to be moving your stop loss up into profit as the price keeps climbing. That way, even if it suddenly reverses on you, you're still walking away with actual gains. Now the reason I say that is because a lot of people enter crypto and they choose the higher leverage and they think they're gonna get lucky with one single trade. Because they're gonna predict the exact bottom of some random coin and then shoot for the moon. In reality, what's way more likely is that you will lose your capital in the minutes that will come next, and then you will say that crypto is a scam and you actually did something right but it went wrong. First off, the market does what it does. It doesn't promise you gains because you took a lot of risk. The main thing you need to first stop doing is chasing those ridiculous moonshot trades. Those can still happen, but it's very rare and it's pure luck, and you can't build any kind of real strategy around luck. If you actually do end up in a trade that's really going well with you, you need to always protect it. Move your stop loss into profit so you actually lock in those gains instead of just ending up with a screenshot and nothing in your account like most people. And when it comes to managing risks, one of the biggest mistakes beginners make is with how they size their position. This also goes back to this moonshot mentality I was just talking about. Trading is not about trying to get rich off one single trade or trying to get rich quick. That way of thinking is way closer to gambling than it is to actual trading. If you ever catch yourself thinking something like, if this coin goes to this price, then I'm going to make this much of money, then this is a clear sign that you are risking way too much and you actually don't have a strategy at all. You're not trading, you're gambling. And the real step that you need to take is to pull back and think with yourself, because this is not how trading works. Another really important rule is to never just go all in one single trade. Even if that all-in trade somehow works out, the risk you just took was still completely unnecessary. And if it doesn't work out, you will completely wiped out, lose your capital, and need to start again from zero. For example, did you know that if you lose 50% of your account, you now need to make more than 100% gain just to get back to where you were before? So that's why it's very important to think with percentages. And it's also one of the reasons why I actually cut my losses early, because if you stay long in the game and keep going, you're gonna actually grow. But if you actually get losses after losses and high losses, you will eventually get kicked out. So the whole goal is to actually grow your capital steadily over time by being consistent and disciplined in how you trade. And what's actually also amazes me is that I've seen people having a losing trade and adding more margin to it and adding more to it. That way they can keep being on the trade and not stopped out and hope for the trade to turn around. So this is very wrong, guys. You should have a clear strategy with take profits, stop loss, and follow it. And the reason why people do that is because they're emotionally attached to that trade. They say to themselves, if it recovers, it will recover faster this way. And this is actually a very bad habit to get into. If you're sitting into a losing trade, just get out of it. It will not magically reverse when the technical analysis is clearly telling you otherwise. Close it out, take a step back and re-evaluate what's going on and look for a better setup. Now let's talk about revenge trading. This is when a trader takes a loss and then immediately tries to make that money back right away. It's driven by emotions like anger, greed, frustration, and when those emotions take over, the traders start making impulsive decisions. They start thinking that they should increase their risk and that they should completely ignore their strategy. And most of the time, this actually just leads to even bigger losses. If you lose money and you start feeling those emotions, once again, stop and take a break. Even just a short break will make you think differently. You always need to step away, reassess what the market is doing and what your strategy is before you jump into another trade. Alright, you finally made it to the end of this course. I want to use this last part to give you some direction on what you should actually be doing after this. And also just to tie everything together so you're not left wondering what's next. So here is the deal. You've gone through all this material, you've learned about charts, pattern, indicators, but none of this matters if you don't actually use it. The first thing you need to do is get yourself set up properly. That means opening an account on TradingView so you have somewhere where to analyze the market. And you can also sign up to an exchange like MXC and actually execute the trades when you're ready. And before you even think about putting real money on the line, you need to backtest. It's very important and I cannot stress this enough. Go back through the charts and test out the patterns and strategy you've learned. See how they've performed in the past. Did they work? How often did they fail? And what were the conditions when they succeeded? This step is absolutely crucial because it builds your intuition and it shows you whether what you're about to trade actually has an edge or not. And most people skip this part and jump straight into live trading, and that's one of the reasons why they lose money fast. Once you've done your homework and backtested properly, then you can start trading. But here is a rule: learn first and then earn. Don't flip that order. I've seen too many people chase money before they understand what they're doing, and it usually never ends well. When you do start trading live, keep your position size small. You're not trying to get rich off your first trades, you are trying to learn. And what you're trying to learn is how the market moves in real time, and you will get also comfortable executing your plan under the real conditions. Making money from trading is an actual blessing, but only if you survive long enough to gain it. Everyone learns differently. Some people want to read everything, study every details, and take tons of notes before they ever place a trade. That's actually fine, but personally, I learned by actually doing it, taking small trades, making mistakes, trying to figure out what worked and what didn't. And I also was studying the whole time, but the real breakthrough came from the live experience. So you'll have to figure out what actually works best for you, because trading is also dependent on you. Now I'm not just going to leave you hanging out after this course. I'll be posting more content on my YouTube channel, new strategies, market breakdowns, all the kinds of things you'll need to succeed. But I also want you to follow me here on YouTube, and I also share content on my Instagram, Telegram, and newsletter. If you don't want to miss anything, I encourage you to be on all of them. And I know you've got this. But before, let me quickly recap what we actually covered in this course. We talked about the support and resistance, where the price tends to react. We actually also went over the trends and how to spot them and when they're about to reverse. We broke down the different patterns and indicators, and the whole point of learning all of that so you can stack them together. When multiple signals line up and point in the same direction, that's homogeneous, and that's what gives you a real edge. And we also covered the risk management, which I also think is very important. And if you actually paid attention to all what we've been covering, you're actually already ahead of most people trying to trade crypto futures. That's it. If this course helped you, you can also share it with someone else who's trying to learn, because I believe a lot of people need access to the right information. And once again, it will also help the channel grow. It's been a pleasure. I hope to see you here and my other channels. Good luck out there, and see you on the next one.